Welcome to another presentation from SME.TAX. Nothing much I'm going to say, but before starters, this is my first presentation, so it's actually sick. You will bear with me. Over and above that, my name is Mlondi Shando. I'm one of the franchisee of SME.TAX. I'm based here in Devon, as well as Mpang in Richards Bay. And I know this is not your first presentation that you have come to attend today, but I'm just going to try and add on everything that has been said before. Mainly, my break ice point, I'll say, I think Taron has done a lot, has given a presentation in terms of a lot of issues that we need to focus on as the SMEs. He's the one who's a guru on this issue. I'm just here to cover up for him. He is not around. Normally, these guys from SME.TAX, Ken and Taron, they will travel from Johannesburg and PE just to come and assist here. But over and above that, I think it's just to give a layout. I think it's much of a privilege for us as SMEs still developing, one of the SMEs as well, to get this opportunity working with some of the things. We need to thank SME.TAX with King Sharks as well with this opportunity. Because I'm sure with such sessions that we had, especially with Ken, there's been a lot of information that he had given us. And if we have to go somewhere else, there's a lot of money we pay for such. So therefore, I think we need to give credit for issues, and thanks a lot for this guys, Ken and the guys.
And Taron, too.
And Taron as well. Especially as he's giving a lot of information just to uplift us and make sure you want to make sure that you want to see us at another level. So our discussion today is just a continuation of what has been taught before, but we're looking at a small business corporation taxation, and with regards to issues of how as SMEs can benefit with a lot of incentives that are there in place to take this. But to go back, I guess most of you were here when there was a discussion with regards to management accounts and taxation. On management account, we dealt with income statement, which is profit and loss, and then we dealt with e-balance sheet. So on those two areas of discussion, when we understand management accounts, it becomes easier to utilize them. Whatever we're going to discuss today, just go through. It's only going to be a long session, but what we're going to go through here, it will drill back to understanding of your balance sheet and your income statements, because most of the items that you're going to learn today, which you can utilize to save in your business, will be coming from that space. So small business corporate tax, what is it, and then and how do I qualify as an SME? Firstly, you need to understand is your business viewed as a SPC by SARS. So there are certain steps and categories that we need to fill or to accomplish to be regarded as an SPC, a small business corporation. Because for starters, if you're a small business corporation, there are certain incentives and lenience in terms of taxation amount that you are getting billed if you qualified for this. Of which I think one of the things that probably government is utilizing those is make sure that it's more like assisting the SMEs in terms of competing with the big guys. We're getting all those incentives along the line to help you to manage your operation. So one of them is, firstly, we need to make sure that if you are turnover less than 20 million, that's your starting point. But as within the business, obviously, you've got SMEs, you've got smaller businesses, you've got medium, and you've got large business, large corporates. So if your turnover, your gross turnover per annum is less than 20 million, that's your first starting point. We fall within a small business corporation. So obviously, if you turn over roughly about 100 or 100 million, and so you're classified as a medium entity, and anything 500 meters above, then you are a large corporation. So your business should turn over less than 20 million. And then it's happened. Obviously, if you want to, it's possible that you might find that yourself, your turnover is above that. But people will always use strategies whereby you will split your company. Probably you are an individual shareholder within the company. Then probably ask your spouse or your whoever that's within your family that can register a company. You split your operations within the family, but you have individual shareholders within the corporate. So that's that space you are leveraging on unavailable opportunities. And then you need to make sure that all the shareholders of the corporates are natural persons. Natural persons like me and you, we are natural persons, and taken into that space. You as a shareholder of a company or a direct shareholder of a company is a natural person, and make sure that you only own that particular company. You are not a shareholder of another company, which would be you split shareholding between two entities. That automatically disqualify you under the SPC. And it might also happen that as a shareholder, you've got a partner that you are shareholders in the corporate. The same thing as well. If your partner or in the company has got shares on another corporate, that also disqualifies you to benefit under SPC. Are we still on the same page? And that's what we talk about natural persons. Okay, do you own one, or do you only own your one business? Which that's what I've explained now in terms of shareholding owning of the company. If you're a shareholder, you need to be owning that company alone as well. And then it does happen that you find that if you're a company, an individual company you can have a company that you own can have ownership of another company in terms of it's a shareholder of another company. What we normally call it a juristic shareholding. It means your company is owning another company, but obviously that company needs to register with SIPs as well to qualify for it. So your company might be owning certain shares in the company, so you are still within that stream, so you're qualified within the SPC. And then they will say does less than 20% of a turnover come from investment company. So if your corporate is owning certain dividends in another company, like maybe you are trading or something, or it's getting shares on the JSE, you need to keep within the less than 20% of the dividends that you're getting from those investments. So anything above of your limit, then it disqualifies you as well within SPC corporation. And then is less than 20% of your income from personal savings. Personal savings, we're talking about the service offering companies like your architects, like your accountant as well, service providers or doctors and so forth. So as much as you operate that, most of if mainly more than 20% of our income come from there, that it disqualifies us as well. But is it worth it if you decide to be part and parcel of the SPC? Obviously, you can see from Sarat within the income tax bracket. As a small business entity, if you qualify for that space, you need to make sure that if your net profit, the taxable profit are 95,150, you don't pay any tax. But if you're a normal company, anything that you profit on, you get billed. That's about 27%. And then it goes on like that. Probably if your net income between above 95,750, but less than 365, then you start getting paid tax there. But I think it's about 7%. That's annual. Annual, yes, we're talking about annual revenues.
When you submit your financial,
your ITR, your income statement. Yeah.
But those requirements, they must meet all those requirements.
First, you need to meet all those requirements before you don't qualify. Yeah. But even if you can try and overrun, do things to those, when they pick it up, it's a mess. And my problem with other advice is you find that probably people, it's easy to form with one, speak with another person that form a company and you register SIPs and so forth. And then you understand that this becomes a dormant company, it's not doing anything. Yet you've got other business that you're operating on. So the best advice, try and maybe deregister as a shareholder business. Try by all means to deregister. If it's not working, deregister and then try and make sure that you become an SPC so that you can benefit on all these incentives.
But if the second company is dormant,
Yeah.
you can still qualify.
If it's still dormant.
But you'll have to prove it, yeah.
Oh, okay. Yeah, obviously, if it's dormant, no action is taking place then. But you, as you say, you need to prove that. And then obviously, it's gradually goes like that. Obviously, if your net taxable profit by the end of the year is less than 550,000, it also gradually goes there. Like so from 65, looking about 7%, and then less than 550, that's about 21%. But then it's also added the 7% from there, then you get your taxable income from there. So as an SPC, you can see your tax saving that you accumulate. Those are saving that if you maintain from, let's say, from 550,000, you're saving about 90,000 rand a year, of which as an SPC, and one of the key reasons for such sessions is to give an eye opener. So if you SPC, then the potential saving that I might get by the end of the year, and then how can I utilize those savings to grow my business? Because those savings then can be used to reinvest back into your business and grow it going forward. Okay, besides the income tax savings, there are other savings that you can get from being an SPC. SPCs are allowed to depreciate their productive assets at a faster rate than other businesses. Like I've said from the beginning, that this also comes from your understanding of your management accounts, which they assist you in terms of benefiting from utilizing these incentives. Like for example, if you're an SPC, we are allowed, if you have purchased your productive assets, like you've purchased probably a laptop or anything that you use to run your business, it can be a vehicle as well. In normal times, companies for a vehicle, probably depreciation period could be run about 5 years, 6 years, depending on the company policy. So, but if you're an SME, like a project, you're anything less than 10,000 or so, you can depreciate that within 1 year. So depreciating assets, obviously, depreciating general, that means you are reducing your taxable income at the end of the year. Okay. By 100%. You can depreciate 100% at one go. For a vehicle, probably you can depreciate first year can be 50%, and then second year 30% or third year 20%. As long as SPC, we are more than allowed to first depreciate your assets. So in that instance, your depreciating assets, it goes back to your taxable income. It reduces your taxable income, then you pay less on it. Or extras. Although not physical cost, it captures as an expense on your income statement, thereby reducing your profit, as you can see from the table, to show the smaller profits paid previously. If I'm asked to do, first to understand the issue, how depreciation works within the accounting space.
To let that point, I have no idea what you're talking about.
Okay, what happens if you've got a business, you purchase an asset to run a business, obviously the value of your asset goes to balance sheet. And then it's got a it's got a life that is going to spare within the business, within the operation. But obviously, every year you need to depreciate the assets as due to wear and tear. So your wear and tear. So probably the normal depreciation percentage could be 20% every year, 50% every year, depending on what asset is it. So but the general is when you depreciate it, that means you're expensing it into income statement as a depreciation. And then whatever you have accumulated on that asset remain with the balance sheet, within the balance sheet. So two contract journals, it's a depreciation journal and an accumulated depreciation journal. So your depreciation journal goes to income statement as an expense. So it becomes part and parcel of the operating expense. That means it reduces it increases operating tax, but it is reducing your taxable income. Just try to put it. Unless you want to add something there?
Yeah, I just want to put it simpler. So you buy, say your company makes 500,000 profit this year, then you got to pay SARS 28%. Okay, on 500,000. What's that? No, my calculation, but it's like nearly 200,000 rand.
Yeah.
But you bought a bucket or a machine for 400,000. So you depreciate that. Money gets changed hands. So SARS take that 400,000 depreciation from your profit. So then you're only paying tax on the 100,000. So then you're only paying 28,000 instead of 200. These are the small things of why it's advantage. So it's not direct cash in your pocket at the end of the month, but it's not giving SARS 200,000 next year. You keep in 80% of that. And it's playing the rules.
And then there are shareholders of small business who pay the maximum rates on their income, have the opportunity to gain tax benefit by using the use of salary and dividends. This is another option whereby within the final year is finished and then you have made a lot of profit. You've got an option whereby instead of paying tax, you can pay yourself salary or dividends within the business. Obviously, that will go to your balance sheet and then it reduces your income in terms of operating taxable income. Therefore, it's either you pay yourself salaries or pay yourself dividends. That's mainly playing around the issues whereby we're not paying physical cash to SARS, but you keep it within the business. So we just get to tax you. Pay yourself. Pay yourself, but even if that's the case, you need to like a different breaking point whereby you can say you need to understand if I pay myself so much, how much pay can I pay? Can I have to pay SARS? Or how much must I pay SARS in terms of income tax within the business? Or how much can I gain by paying myself dividends? So then you work it out around that line so that you make sure that you don't pay a lot of money within the SARS, but you keep it within the business. Hence, I've said sometimes you need to understand probably my financial, my profits are so much within the schemes that are available that I can benefit out of. And then you sit down probably with your accountant or they say, this is my target for using that money to grow the business. So maybe your profit of 1.8 million. So that will be your mix. That means I'm paying here, how much I'm paying salary, how much I'm paying tax for dividends tax on myself or on the shareholders.
But that's no, well, let's have to look at. I mean, this recording is all available to you afterwards. It'll mail it to you. So it's basically the different options of taking a salary, paying company tax. Because say it's your company. Well, what is our plan? To pay the least tax possible.
Yeah.
Now, there's certain salaries and dividends and company tax that work out less, depending on your salary and if the company's showing a profit, how much dividends you can take. We did this exercise exclusively for some high-end clients, turning over quite a lot. And the cheapest for them was to actually take pay as you earn. You with me? To drop the company tax. But that scale is weighted in the smaller companies, where it's better sometimes take a lower salary, you pay less pay as you earn, then you pay dividend tax, which is fixed at 20%. But then with dividends tax, your companies run at a profit, so then you pay in the 28% with that. But then if you SBC, then 28% is gone if your profit's only 500,000, and then you can get away with the dividends tax, and then you only paying 20% to SARS instead of 28. So each one, like Mlondi says, is linked to the financials of you and where you are and your salary expectations, and that's the tax planning that people should do. Because I mean, we just showed you a few small graphs how you can save with the depreciation and the SPC. You can save 200,000, and companies our size, 200,000. I'm paying less out is a lot of stuff. It's trading stock, or it's a next car, or your next machine to build your business. Because that's the
main
tax strategy.
Yeah.
I hope that helps.
Yeah. But another thing you need to understand, probably you need to also understand the brackets where when you start paying your pay as you earn. Like anything that if you pay yourself as a shareholder within the company less than 7.9 of that, you don't pay income tax. You pay as you earn. You have to deduct only your F within the basis. So things like that, that's how you play around. How much am I paying myself? How much am I paying for the income tax? How much am I paying to dividends? So that at the end, I'm not sure that I pay as little as possible to SARS and keep it something else for myself and the business.
Okay.
And another incentive that you get, it's called employment tax incentive. So this incentive is really aimed at encouraging employers to hire young and less experienced work seekers. What happens here is that's when you're running your small business. Probably maybe you are the employer within the business, probably you're a shareholder director and you're an employer within the business itself. Probably you might have someone working in the business, you've had some of the skill employed that's doing yourselves. Obviously, you're going to pay a bit higher, maybe skill some within the production, you're paying them higher. Obviously, you have one or the other, you're able to pay as you have. So what happened is this incentive is there to benefit the small business corporation, whereby you try and employ probably anyone that's unskilled, still within the bracket of being a youth. So what it does is you take them in, obviously they're not for whatsoever. You train them, make them understand what they need to be doing in the business. And probably their salary scale as well will be much less, and maybe pay them 3,000 or 2,000 or so.
Between 4,000 and 6,000.
Yeah, between 4,000 and 6,000. Obviously, paying them less, obviously they also don't pay as you earn. So what it does, this incentive came to back in 2014. So the employers who are registered, but for you to benefit from this, you need to be registered with SARS and be compliant as well with regard to pay as you earn and submission of your EMP 201s. Obviously, the benefit will be limited, and who doesn't qualify on these ones is your government departments that are listed within government gazettes. Employers who have been disqualified by the Minister of Finance due to displacement of employees of conditions may be prescribed by the Minister's regulations. And then when can the incentive be claimed? Employers are able to claim incentive when they employees. Firstly, there must be South African ID document. they must be within the age of 18 years of plus, which some of them are going to be productive in your company. And they must not be related to you as an employer or a director of the company. And they must earn at least a minimum wage in terms of regulations. So employee must earn 2,000 rand more if it's wages. So they must earn less than 6,000 rand per month in total remuneration. And okay, they are effective from October 2013. So an employer can claim incentive by decreasing the amount of pay you earn payable to the SARS for each qualified employees hired by the employer. So basically what happened is you find yourself you've hired those individuals within the company and then all the requirements. Obviously, at the end of the year, you're allowed to claim some incentive from those employees for the period of 24 months. So the first claim will come in through within the first whatever percentage, because it's coming to show what percentage are there that you can claim from those money to pay them back. Employees, and you submit your NPO to one to serve. Every month you claim back those monies. It means instead of paying whatever salary you pay bills, what you pay to those employees, you claim SARS pay you back. So it's money back as well. So it's mainly what we are doing as well. As much as you benefit in terms of giving people jobs and experience also, but the government pays you to do that function for them initially. It's gradually. For the 12 months can be.
Can I
Not the whole 12, not for 12.
Can I just jump in here?
Yeah.
Sorry. You've got a company with 5 employees. Okay, and you're paying as you earn for those for 2,000 rand. Just hear me out. That's 10,000 rand. You've got to pay your normal employees to SARS for pay as you earn. Now you employ 10 youth. Okay, there's no pay as you earn on their salary, they're in the minimum. But SARS give you a credit for 1,500 rand per youth. So that's 10 youth, they get a 15,000 rand credit off your current company. So you do your calculation, you got to give SARS 10,000, you count your youth, I've got 6 youth, is 1,500 each, it's 9,000. You submit the 9,000, you pay SARS the 1,000. You under with the youngster. He's getting his pay slip with his UIF and deductions as per normal. The company is benefiting on its payroll tax that it's supposed to give to something. Oh, that's better.
Is there any question maybe on that before we go? Okay. So how does it work? In determining the value of incentive in particular month, a month must follow these few steps. Identify all qualified employees that for that month. We determine applicable employment period for each qualified employee for first 12 months or the second 12 months. And we determine each employee's monthly remuneration, calculate the amount of incentive per qualified employee, and then you aggregate the results. Good.
Thank you. Go with that.
Okay, this is mainly what Ken was stretching in terms of how does it work. Like mainly to whatever brackets, then for the first 12 months with that you can get 1,005 per employee. And then the next 12 months, and then it's about 750. What? Is it clear?
You guys happy with it? So go back. That's per youth.
That you have employed.
Good.
It's just how to activate it, how to.
You do it with your payroll.
Yeah, because you've got a standard payroll that you're running and you're paying as pay as you earn for your current employees. So when we employ those individuals, for 1,005, that means instead of paying SARS, whatever the amount you're paying, you're gonna offset that 1,500 from the benefits that you're getting, that you employed.
To most tax registered works.
Well, they should, but a lot of people are lazy and they don't do it. It's a big thing. We took over a company in Cape Town. They had 10 people last year, the whole year. That's 15,000 rand a month.
That you can pay. You should have
A month. That's 180,000 rand for the year. We got them back on their pay as you earn.
So when this session are mainly to highlight what possible benefit that you can tap. So when SARS calls, you shouldn't be worried. Most of us, you just don't even want to hear what SARS is saying. So, but most of the information is there for you to utilize and benefit your small businesses.
But that's why you're here. Now you go to your bookkeeper and you say, hey, where's my ETI?
So I'm paying so much on the SARS. How am I benefited by this year that I have in the business? So they can claw back and then claw back whatever you've been paid, you have missed in paying those guys.
And these tax savings up through all these SPC things we've gone through, and work it out over 10 years. How many people, like you say, some bookkeepers aren't doing it correctly. How many people have, in 10 years, that's R1 million you've lost, which could do a lot better in your retirement plan or your kids' college fund. So all these small little things were SARS.
And with regard to income tax as well, if probably you just realized that you are in SPC, but when you look in terms of percentage of tax that you have been paying, you still have a leverage that you can claw back from about 5 years back. And then we say, go get someone to do it for you. Say, SARS, I've been paying probably 28% instead of 7% or 21%. Can I have my money back? And they will, for past 5 years, you can get your money back. So the reason for ESTI means mainly to encourage millions of young South Africans are excluded. Obviously, we all know that, and that suffered disproportionately due to unemployment and economic monetization. So high unemployment was not going skills students. So your duty is mainly to give them experience. After 2 years, probably you might employ them full time, or well, they might get jobs somewhere else. But they've skilled, they've got experience as well, and they've got references.
That's it. So who interested?
Obviously,
SARS have got pretty strict rules if you Google on their site. A connected person, obviously through marriage, family, other businesses. It's got to be accurate. There must be a barrier between. Then there's never going to be one between you and your wife and you and your son. Yeah. No. Yeah, it's a blanket cover for SARS. Yeah, it's because you do big with people going overseas and the wife starting a business there. You know, this whole not connected person story. So we don't make the rules.
and also you must distinguish that there's a fine line called ETIs, which is employment tax incentives. We do have learnerships, which is something different, but internships, which is something different as well. But we learnership obviously found that probably that to pay that money must get it from a sitter, whoever sitter is belonging or in. So it's different categories. It's ETIs, but learnership, for instance, internship, which is 3 different categories. And another incentive that SARS gave us is with regard to solar panels or solar power. If within your business you have installed solar panels, don't have to be something more expensive. But if your business can afford that, obviously it's fine. But any panel that you might have, maybe we will spend about 6,000 rand just to work home, have electricity due to load shedding. So the cost of, obviously, the cost of those panels as well, you can depreciate them, but then they help you to reduce your taxable profits. And if you have spent 200,000 of those, depending what your taxable profits are there for the year, so to counter paying so much, then you can depreciate them at a faster rate. So those are technicalities within solar. I'm not much of an expert with that, right? But the accelerated depreciation allowance came about from the proposal from 2015.
Blondie, I think this is different. And I understand what you're saying, because this year they gave on the panels only,
On the panels
on your personal
okay.
income. This was in 2015.
Yeah, this was
for the whole solar installation,
installation.
for the production of business.
Okay. So the reason for the change is to accelerate and incentivize development of smaller and photovoltaic solar energy projects. So the government initially what is advocating systems whereby if you can afford to put your solar panels or solar system within a business, do that, then the certain incentive that you can get out of that in assisting with your project. If
For
you're
your home office.
You are working from home.
Something like that.
Home office is working. It's a working space. and also another idea. If you are working from home as an SME, obviously there's certain utilization that you like. You use water, you use light, you use your space in your home. So when you are filling up your management account or doing your costing, you should pay rent for your business. So that space within your you pay rent, pay utilities in the business space. Even though you are working from home, you can do that as well.
And it's right down to the square meter.
Section
Was in order. It's a house plan. This is the office. This is the storage space. This is 25% of the total land, of the total place, and then put your bond on your electricity and your water, and you can 25% of whatever that percentage is of the space. As a business,
so even
legitimate business expense.
You can take it. We can take it from there as well.
No, they know you've paid it. Yeah.
So this was mainly to help address the energy shortages facing us, South Africa, in a more cost-effective way. Section B of income tax provides for a capital allowance for movable assets used in the production of energy. So more specifically, it allows for deduction equal to 100% basis. So deduction that means you depreciate that asset can be 100%, then it goes to your income statement, it reduces your taxable profits. The company, currently company taxes is next starting point for next year forward. So my advice for you guys, especially there's a lot of light bulb moments that we have received throughout if you have attended most of the sessions. So in terms of drafting your goals going forward, I would say for you to be in a position to utilize these incentives, you need to have a structured goal, say within a year, accomplish. And then understanding your management accounts and say, I'm going to be utilizing this and that, saving from this line, maybe from SARS, what I've understood. with regard to depreciating my assets, so whatever saving profit that I'm getting in their business. And another thing that you can also need to understand, if you started business from nowhere, probably you might have spent some money. The car that you've been driving, it's using for your business as well, but you have never took it, it's not in your balance sheet. You can still do that and use the car to depreciate it back to assist you in reducing the taxable profits. On my side, if there are any questions, probably.
Is this, I don't know if it's a training video that is around social media right now about the corporate businesses that are normally about sharing like 10% of their profit. As you used to say, your business has been registered for MSCA, but doesn't need any income yet. And how are you make sure the 10% profit?
I haven't heard of that. The only thing that I know is with regard to ESD and grants with corporates, which is whereby they are promoted that they must spend about 3% of their net profits into uplifting the SME companies.
Because there is another.
Unless Ken is good, then I thought that.
No. I also know it's at the big corporates, and they get points. Obviously, they get more points if they're preferred suppliers that they use in BEE companies. Is that what you mean? They spend with the BEE suppliers. Yes. So obviously, all the regulations are in place to not only one company be uplifted, but we share and you pay it down. The big mines in that, I think Mlondi's right, it's like 3% has to go to ESD and ED and socio-economic development. The other thing, you've answered your own question. If you never made a profit, what's 10% of your profit? 10% of nothing? Yeah, so that's it. So you've got your turnover, but I mean, you run your normal business and say you make 50,000 rand profit, and you bought stuff at the hardware at the garage. All those people have got BEE certificates, and you put those in Nepal. That's where your spend is.
When I had a meeting with last time, he told me that I should register for a beneficiary ownership, something, because maybe from next year, which is 2024, I won't be able to change the bank account because right now I'm using FNB, so I want to change the bank account to net bank. So he told me that I won't be able to do this because I don't have a beneficiary ownership certificate, something like this. Because
no, you're gonna have to drop. Well, you got Mlondi's card. Drop us an email exactly because something's not clear. Are you the only owner in the business? Are you the only shareholder?
I'm there.
The shareholder and the director, and you've got a shareholder certificate. Yeah, so I'm not sure what the requirements are, but we open bank accounts for people every day. I'm not, unless you're applying for something that we're not sure of.
Very cheap to open a bank account. It's like because the one I had, FNB.
Yeah.
Business.
But the thing is, I don't know, paying money. If you, like, for example, if you register a company, if you register a company today, your company will come. You've got linked. You can, once you open it, it's linked to FNB. You can open an account. You don't have to pay that much. There's sum of money. No, there's other banks. I'm just making an example of FNB. you gotta go to ABSA or any other.
But even if the deposit is to open the account. Yeah, just to exhibit the account. They said it's better as a big.
550.
Yes.
Well,
The account.
I wouldn't speak for FNB. I don't want to.
Yeah, I opened
but
it,
no,
the Standard Bank the other day and I never pay.
Yeah.
And then the one in the hence I'm saying the one I had a meeting with, this one it's like 200 grand to open a business there. And I'm like, wow.
Sorry, can we just finish
Okay,
this chat?
yes.
I just want to get rid of them. I'll not
Okay.
get rid of them either.
Thank you so much for today. You're gonna be. Okay.
We'll see you next month. Thanks a lot, guys.
All right, thanks, guys.
Cheers.
Thanks, Ken. Thanks everyone for joining. I will be sending the slides as well as a link to the video. If you have any questions, please email edward@sme.tax.
Right.
Thank you.